Hello, and welcome to the C-Suite Chronicles podcast. We're bringing you the top voices in tech leadership. In this episode of the C-Suite Chronicles podcast, we're talking about all things early stage fundraising. We have a panel of experts who have raised early stage capital or who are in the process of fundraising, and they have some fantastic stories and words of wisdom to share on the current fundraising environment, lessons learned, and the challenges and opportunities they encountered along the way. Our esteemed panel of founders includes Mona Akmal, CEO and co-founder at Falcon AI, Pranya Desh, founder and CEO of Avocat AI, Joseph Gradante, CEO of Alio Finance, and Brandon Schultz, CEO of Violet.io. Now, without further ado, let's get into the podcast. So thank you all for being here. Before we get started, I'm just going to have you all do a quick introduction and give us a little bit of information about your background.
Yeah, sure. Really happy to be here. Thanks, Robin. I'm Mona, CEO and co-founder at Falcon AI. We're a Seattle-based startup company focused on go-to-market intelligence. We raised 16 million Series A round about 4 months ago. So, by many definitions, the worst time to raise, but we lucked out. And my background is product and engineering. I've done the big company thing and the small company thing, and it's a joy building this company.
Hi, I'm Joseph. Like I said, I'm in Lake Oswego. My background is mostly in capital markets. I started out as a global macro strategist on the buy side. Was on the retail side, was on the sales trading side back in New York, and then I transitioned over to tech. I was at HubSpot for a little bit. I did a few accelerators. Built up a pretty nice Rolodex back in New York, and so saw the emergence of fintech, and started raising capital. And so we've raised $7 million to date at Alio Finance seed round.
Fantastic. Pranya?
Yes, Pranya Desh, Avocat AI. Avocat accelerates revenue by automating legal processes with AI and contract generation with redlining on platform. So my background is that I was a U.S. diplomat representing the United States at the World Trade Organization in Geneva. And then after that, I was a law firm attorney, which is where I saw the need for Avocat. And so we are very early stage. We only launched product on the market in the last few weeks. And so we raised a pre-seed round of $1.4 million, and we are currently raising a bridge.
Brandon Schultz, CEO of Violet.io. Violet is a universal commerce API as a service. So we allow anyone to build basically fully integrated checkout in any experience that isn't their standalone website store. We have raised $14 million to date. We raised a $10 million Series A at the end of last year. And have really kind of stumbled into this market from focusing on it for the last 10 years or so, basically. Lots of people have talked about social commerce and all kinds of different ways people should purchase things, but they often kind of neglect the infrastructure part of that equation. So we fall kind of squarely into that like B2B SaaS, API first, right up the middle type of a company. And that probably impacts this conversation a little bit just in terms of valuations, capital raise, et cetera.
The environment in 2022 has been vastly different than it was in 2021. And I wondered if we could start off by talking a little bit about that. What's been your experience out there in the market? I feel like, I was doing some reading earlier from folks who were talking about this kind of earlier in the year. I haven't seen a lot of coverage recently, but basically at that time, they were saying this is a really difficult time to raise money. Businesses should be preparing for, to have a longer runway and pay attention to burn rate and all of that. Do you feel like fundraising is harder now maybe than it was last year, or, harder in general? And if so, what changed? I think we look at the economic climate, we look at the geopolitical climate, there's a lot, COVID, there's a lot going on. So we'd just love to get your perspective.
Well, it's brutal out there right now. Even though a lot of funds have dry powder to deploy, they're hesitating. So it used to be, even in the speed in which meetings get scheduled, we see it, right? It used to be that you could get a meeting within a couple of days. It now takes 2 weeks to get the exact same meeting that you would have gotten. And so then the whole process is just slowed down. So that's what I'm seeing.
So I think I'll probably take pre-seed and seed as a standalone. Series A, I think, is sort of a fundamentally different thing now. And I don't know how many people listening here are explicitly going after Series A, but Series A is really hard. I think if you're trying to go raise a Series A right now, you're going to probably have the most difficulty out of anyone, just given what the new requirements are. If anything, Violet was lucky to some degree around our timing, right? So we raised a $10 million Series A 90 days after our seed round. So we ended up raising $13 million last year. In most markets, that's not going to happen. Part of the reason that happened was what was a prior seed investment became Series A investments. So all the late stage Series A, Series B investors were trying to get in earlier and earlier. So you saw a lot of those hedge funds working their way in. You saw Tiger Global, SoftBank, and I probably put Coatue in that bucket. All of those companies were all of a sudden putting billions and billions of dollars that used to be deployed at kind of Series C and later, and they were then moving their way up, sometimes even into seed rounds. And so I think a lot of that pressure is what created some of the investment culture that you then saw. So as a result, all these early stage firms were forced to increase valuations, increase capital investment, et cetera. And so that was actually really good for a lot of us over that period of time. And that particular, I'd say, pressure has gone away. And so there are still a lot of great pre-seed investors and a lot of great seed investors out there. They have capital they want to invest. But I would say the overall valuations associated with that, and to some degree, the early revenue rigor has changed. I like to look at the conversation I like to have with investors is around future valuations. And if you're talking with an investor, I think it's a little bit of a misnomer to say that we are in a place where the market has fundamentally changed. Because if you're raising a pre-seed round right now, that investor is not expecting to get their money back for probably 5 years, if not 10 years. And so we don't actually know what the market's going to look like 5 years from now, let alone 10 years from now. And same, 5 years ago, people that were raising had no idea that there'd be a downturn like there is today. And so the right pre-seed investors and the right seed investors understand that they're looking for the right companies and they will make the investments. And so that's likely where, if I were in this position, I would try to focus and be able to say to someone, here's the bet that I think needs to be made. Here's the team that's going to go and make that bet, et cetera. But otherwise, outside of that, it is getting, I'd say, more difficult and it's definitely getting tighter.
Yeah, when we started raising in May of this year, which is right about when the meltdown was at its peak. And I was advised by many founder friends that, you're going to have to talk to 100 investors to get one term sheet. And we spoke with 6 investors and closed our round, which I think goes to Brandon's point that the hype cycle, first of all, how has fundraising environment changed compared to what, right? So if you compare it with what was happening in 2020, which I think of as pure scam, right? Just fraud. I don't consider that fundraising. So I will consider that the anomaly, not this the anomaly. If you compare the current fundraising market with how things were in 2016, for instance, it's much more back to normal, where unit economics matter. If you're a Series A company, you have to have revenue. You can't be pre-revenue unless you're in a very specific specialized space like cybersecurity or fast databases and so on. So I think that what I'm excited about is there's a lot of money and capital in the market. If you look at PitchBook data, investments are not slowing down. They're just becoming a lot more thoughtful. So net revenue retention matters. David Sachs put out, 6 core metrics of a business that you should be tracking, right? You should not just be looking at new logo acquisition, but also how well are you retaining those logos? Do you have an expand cycle? Is your customer acquisition cost in line with your lifetime value for your customers? If it's not, you don't have a viable business model. Therefore, you should not be investable. So I would say, our experience has been, if you are a business that has been focused on building something durable and having sound unit economics, you're not going to have a problem raising money, especially if you're operating in a large market. But gone are the days of, showing up in a room and charming everyone and talking about how the TAM is infinite and appealing to people's greed and getting, $100 million valuation for $0 in revenue. So.
Things have slowed down a little bit, particularly on the VC side. But as Mona just said, things were really kind of It's compared to what, right? Things are more, back, I would say, in balance now to where they were in 2015 and 2016. Valuations have been, particularly in fintech. I'm in fintech. I mean, they were insane and they were lofty, and I think they were too big to begin with. So I think it's kind of good. There's been a healthy correction in the market. A lot of the investments that, opportunities that I see that are out there are venture debt and family offices. They're particularly sitting on a lot of dry powder. But it takes longer to kind of move the needle with them. And it's a little bit, in a family office, sometimes it's harder to even get those meetings. You have to be, I think, autodidact and kind of resourceful with how you go about it. Outside of that, I think, great investors still recognize great companies. And, I think Brandon touched upon it. You don't know, the macro climate has obviously changed, but there's a lot of factors, right? Artificially low interest rates for too long, and the uncertainty, but there's always uncertainty. You don't know what the future holds. Good companies are going to be good companies, and business cycles tend to follow a certain pattern. And I have no doubt that it will follow that pattern this time. And, in 2 years, things will be, back to, 2019, 2020, where they were, because that's just the way things go.
We have an exciting announcement to share. We've launched a new brand, Portalis. Despite all the news about layoffs, demand for seasoned tech talent persists. Small and medium-sized tech companies must still compete with large corporations for talent, and small businesses still grapple with how to scale their operations. Portalis helps you recruit and retain top talent by delivering comprehensive health benefits, a high-value 401k, HR management, payroll, and scalable operations. Portalis offers the same services to tech trade associations, incubators, and venture capital firms. This allows them to deliver higher value to their portfolio of companies. Portalis, your portal to success. Visit us at www.getportalis.com. That's PORTALUS. Let us help you grow and succeed. So moving on, I think when you're raising money, there's always, things that happen, scenarios that come up, lessons that you learned. I would love to hear from all of you. What were some of the most important lessons that you learned while you were raising money?
Well, you got to be patient, right? I think things do not move quickly. The due diligence process is long, and you really got to be extroverted. You got to kind of get out there and get over the fear factor, right? And just put yourself out there. So that's basically the two greatest lessons I've learned.
I think it's also to run a really organized fundraising process. And I think in the heat of the moment, it's hard to do that, especially looking down the barrel of runway. But it's really important to just right at the beginning, get it right with your target list and warm intros to everybody on the list, and a very organized and accurate deal room that's just ready whenever somebody needs it, and just be really quick in the follow-ups.
I probably have some counterintuitive thoughts on this. My first lesson is don't raise capital. If you can avoid it, don't raise capital. It is painful. It's terrible. And I only say that because I've gone through the process. I'm obviously very thankful that we have. But I also say that because I think the way the market is structured, those are often the outcomes and milestones people are going after. And sometimes you can lose sight of the things you actually need to be accomplishing from a business perspective. And we definitely fell victim to that. And it's one thing I wish I had kind of handled differently in the past. So I would say figure out any way possible to go as long as you can without raising capital to get some amount of signal as quickly as possible. Second one is, raising capital is not about raising capital. It can't and shouldn't be about that. In my opinion, it's all about belief. That's the difference. Raising capital is the outcome of a set of beliefs that someone else happens to share with you. And so I think, struggled through different types of funding cycles and different markets, and tried to raise in Seattle, all of a sudden got into the New York ecosystem and then the San Francisco ecosystem, and you sort of get bounced around, and every person has a different view on the market. Every person has their own individual experiences. that firm has their own thesis on what they're doing. And especially if you're doing something interesting and new, it's not always going to fit into those boxes. And so for us, the biggest unlock was when I hopped into a call with someone and the person on the other side of that call had experienced the exact pain that I was solving. If that wasn't the case, it was going to be really, really difficult for me to convince them and to get them to give me any money because they didn't share that belief. There wasn't that shared experience. And so that was a big change for me. And so even today, when I go into conversations and I'm having, check-ins or whatever with investors, I'm always looking for, how well do you understand the space that I'm in? Do you have a past experience that aligns to the thing that I'm solving? And then secondly, have you physically been in the pain itself? Because especially if you're in software, it's not like I can send you a mattress and say, hey, your prior mattress was terrible and this new one is really great. For what I do in like e-commerce APIs, most investors kind of look at me with their eyes glossed over and they're like, okay, so you're solving what problem? Like, how do I validate that the problem is indeed solved? And so that's really hard. So I think the more we were able to focus on that and do that sort of pattern matching, the better off we were.
So many learnings. Oh my God. So a few tactical ones and a few more bigger picture ones. Tactical ones, do your research on your investors. There are infrastructure investors and there are application investors. They look at the market completely differently. You need to know whether you're an infrastructure company or an application company, and I'm only talking about SaaS here, and then focus on the investor group that you really should be talking to. This goes to Brendan's point, right? That if you can do and eliminate a bunch of investors, just like you have ICP, ideal customer profile for your customers, you should have an ideal customer profile for your investors as well. And it starts with the firm, and then it should go down to the actual partner you want to talk to. Second, never share your pitch deck, especially in the early stages, right? Pre-seed, seed, Series A is still 50 to 80% about the storytelling of the founding team, and you cannot capture yourself in a deck. So even if people say you should share a deck, I've never shared a deck, and I never will, because you're selling yourself, you're selling your vision. Less is more. Slide decks, data rooms, everything is a crafted story. The more information you share, the more surface area of attack you are opening yourself up to. So share as little as possible. Every investor will have some concerns about why they should not invest in your company. A concern is just like an objection in a sales process. It doesn't mean it's toast. It means you have to be able to handle the objection effectively. Again, where founders go overboard is an investor will throw out an objection or a concern, and then they go off into a 30-page thesis explanation, which doesn't inspire confidence. Give the shortest, most precise answers to handle the objection or reframe the objection. Last trick. Sometimes the objection doesn't need to be handled. You need to say, that's actually the wrong way to look at the problem. Let me give you a better way to think about the world. So you want to play on the offense. You never want to be in the defense. And maybe I'll add one more to this. Even when you're fundraising, you're never fundraising. So all our conversations were, hey, we're not actively looking to raise money. We've got money in the bank. We're just exploring what a company like us would need to have in terms of our core metrics and our story. I even practiced my pitches with partners at really great firms without ever fundraising. It just so happened one of them wanted to, put their money behind us. So that creates this perception of you are the buyer. You're not selling your company. They are buying the right to participate in your amazing company and your amazing journey. I think that goes a long way, especially in the early stages where it's really about the founder.
Well, so we're a very early stage, as I mentioned. And so we're in the stage where selling the story is what we're doing. So that part has gone really well, is that essentially you're selling a great story of what the future is going to look like. And I feel that's so much fun to be able to tell the story of the future and to get people to come along your journey to picture what the world is going to look like in the future. So that part's going really well. I don't yet have an answer to what didn't go well, just because I'm very in the thick of raising this bridge right now.
Yeah, I think that generally what went well was we ended up meeting with investors that were all very thoughtful. They gave us really good feedback. And I generally tend to ask for a lot of feedback. And I tend to ask for like, what is your thesis in this space? What are you seeing that you're excited about? It really helped us refine our pitch. So every pitch deck after every presentation was significantly better for the next round. So it was like this. Every investor helped us eventually get to the investor that wrote our term sheet, right? So I'm very thankful to the investors for that. What didn't go well? Other things. We learned a lot about competition, right? Competitors we didn't know existed, and what was their unique point of view, and how were they positioning themselves, and how did they think about TAM? So it was a really great time to learn about the competitive landscape. The things that didn't go well, one, this is a little bit, I think, the woman thing or the woman of color thing. Men always get asked about their vision, and women always get asked about evidence, right? So we tested it with me and my co-founder. He would literally say the same thing, and they would ask him to dream even bigger. And if I said the same thing, they would ask me, but what evidence do you have that the future is going to look like that? So, that bias very much exists. And then the second thing is some investors are super fucking disrespectful. They show up late. They are on their phone. And I have a pretty clear policy with them, which is if you show up late, I'm not talking to you, because I don't want to marry someone who doesn't respect my time. And it is a marriage. It's a Catholic marriage. You can't get out of it, right? And if you're going to be an asshole, I'm going to be an asshole back to you. Unfortunately, we ran into two investors that were very much that. So it was sad. That was unpleasant.
That's great. Great story. Joseph, how about you?
Oh, well, we raised, so obviously that was successful. I think the pitch deck does get better. You get a lot of practice, you get a lot of critique, and, I think it just makes perfect over time. What would I do differently, right? That's the other part of it. So, yeah. I don't know, because we raised, so I don't know. I think, you just got to kind of do your best, and life is just a learning process, right? And you just kind of roll through it. So I can't say I would have done things differently, because everything I've done has helped me improve as a person. Like I said, I think just being more extroverted early on, I think, and kind of getting over the fear factor. It took me a while to really start talking to outside investors, people who I didn't know already and have a relationship with.
So in my opinion, raising capital, especially in the early days, sort of was in three buckets as I look back. So the three things that I think we probably didn't understand, but they fall into the buckets of number one, access, number two, timing, and then third, narrative. And I think I did well and poorly at each of those at varying points in the maturity of the company. So in the early days, I really focused on access. I was like, how do I get the meeting? How do I find the people out there I need to talk to? And it's really hard. I was an unknown founder. People didn't really know us. We got really lucky in that there were a couple of super angels here in town that I had worked with in the past. And so that sort of bought us some early runway. That doesn't always happen. And so I think had that not happened, it would have been even more difficult. It probably would have had a different approach for us specifically. But eventually access started to solve itself. So our particular approach to that was bring on some advisors and work with other founders and other kind of lower level investors that were looking in the space and trying to figure things out. And we used that as a form of signal. So like if you're listening to this and trying to figure out how do you solve the access problem, bring on advisors that are either founders at other companies or are really, really strong operators that work directly with investors. That's a huge, huge advantage for you. And then be really picky about who they are and don't just take them for their contacts, because if they're great operators, they're already talking to investors. They're already, responsible for deal flow to top firms. So that's number one. Then after I started to get access, the timing was off. And so figuring out the segmenting of how much we were raising at what time and really trying to match up our company maturity with the market maturity is tough. It's a big part of that capital raise. And so I talked to founders today where, they have an idea and they're just going out to try to raise capital and they're like, oh, we're going to raise a $4 million seed round. Okay. have you raised pre-seed yet? Well, no, kind of. We've got like $100,000 to friends and family. Like, great. Well, like there's, there are things that I would have done differently. And it's not always going to be the same approach that someone took in an article that you saw in TechCrunch because, a particular founder like used to work at Andreessen Horowitz or whatever. And so he was able to go out and raise some crazy round. Like that isn't how the market works. And so that took us a while to sort of understand and like really get into the inner workings of how that operates. Eventually, once we got our timing right and the market aligned, it all sort of fell into place. So because of that, because those two things were off, our fundamentals were required at an early stage. And so we ended up continuing to evolve. And then by the time everything caught up, it just kind of clicked. So I would say really narrow in on that timing. We can have a whole conversation about timing itself, but there's a lot of frameworks out there for this. I generally subscribe to the founder market fit, product market fit, go-to-market fit as like the three trajectories. And so lean a lot on founder market fit. And then against that, find the right firms that will make that choice. The last thing was narrative. Our narrative was terrible for a long time. So we had a giant market we were trying to go after, didn't exactly know how to narrow that down. Being an API company generally is really difficult because you have so many different sides and surface areas to cover, and investors want to have a pretty clear and direct go-to-market motion, et cetera. So we struggled there. That's probably still the hardest one to solve, and you will likely have the most difficult part in that section of the equation, if you will. And so those were the three things that went well and didn't go well. I think access went well, early and continues to go well. Timing was off a little bit. I have a much better sense of timing now, and wish I could have leaned on some other folks to help me out there a little bit more with the timing. And then the narrative was difficult. I think the main comment I wish I had told myself about the narrative when we struggled, and what I'm referring to all the things we did poorly, because I hope that's the areas where people can learn best. But we pitched to everyone in Seattle and got to make some good friends there, but didn't quite have a way to talk about our product and our market that really translated into this particular B2B SaaS type of investor here, which is very different. For us specifically, this may not always apply, but for us specifically, we don't fall into the bucket of here's the software that you're going to use, and you're going to go pay someone X amount of dollars for a seat, and that's going to equate to a certain set of unit economics. And that's how the investor is going to see it, and that's just not how our product works. And so we kept trying to fit into these other molds that people had for us. And finally, one day I was like, you know what? Fuck it. Sorry for the F word. But like, I don't care about fitting into those particular 6 slides that they care about, because this is about the last 10 years of my career. This is about where I think the overall e-commerce industry is going. And at the end of the day, they have to believe that, and they don't necessarily care as much about some burn rate or whatever. And so I really focused in on making that part crystal clear and really well structured. And at the point in which we did that and kind of talked about our past experience leading into the product, how our product solves the problem and where we're at now, and then showing momentum, then again, it all kind of clicked. So those are the 3 dials I would kind of turn: access, timing, and narrative. And then if you get those generally within like 80 to 90% accuracy, you'll probably do okay.
In the last couple of minutes we have left, we would just love to hear, do you have any other advice or words of wisdom that on this particular topic that you'd like to share with our listeners?
Yeah, so I have like 2 main rules of thumb I try to follow relative to raising capital. The first one is I want to try to make sure that in my space and regarding my product, I will always be better and smarter than the investor that I'm talking to. That is a really, really important thing, because at least for me, when I walked into those conversations, there's a really strange power dynamic that bothered me, because someone else on the other side of a Zoom call is the one with all of the power and all of the capital. But they aren't the ones every single day in the trenches trying to solve the problem, let alone with years and years of experience. And so although I had the proximity, which is really the actual currency there, I wasn't translating that enough into sort of a level of rigor and clarity that would give me that position of power about how to go and deploy capital. And that was, I think, a miss for me. And so, when I advise others, I say, when you hop on that call, if the investor knows more about your space and or your product and competitors, you're not going to be able to raise capital from that investor. And so I have that as like a standard for myself when I say that for others. And then the second one is, especially in the early stages, leverage great advisors. They are worth their weight in gold. We got really, really lucky, but the first one is to pick really good advisors, hold yourself to a high standard on who you select. And then once you have those trusted advisors, listen to what they say, and then go build a great product and then build a great team. If you do those things, everything else will fall into place. You'll get the access you need. They'll help you with raising capital. They'll force you into a level of rigor with your own business and hitting metrics and requirements ahead of time, so you won't be surprised. But that was one thing I wish that we had done a little bit. We did it and we did it well, but I always recommend that to people.
I think picking the right board member, that first board you set up, is absolutely crucial. You have to have trust there. You want somebody who's strategic and can really help you in what you're trying to achieve, and know your competition. I mean, yeah, you're going to know more than the investors, but you should just know more than anybody about your space, period.
Yeah, I would say one, think of fundraising and investors just like a sales process or a game. You have to be able to look at the players in the game, understand the rules, understand the motivations, and almost like emotionally distance yourself from the game that you're playing. It's a chessboard. You have to be able to look at the chessboard. Only then are you going to figure out what your next best play is. And tied to that is, obviously it's very difficult to disconnect from something we care about so much, right? And the rejection is extreme. I would say focusing on your mental and physical health during the fundraising process is critical. So if you're not seeing a therapist, get a fucking therapist, because you're going to need that. If you're not working out, really get a fitness coach and put in about 120 minutes of hard workout every week at least, because you need the cortisol from your system to release. Otherwise, you're just not mentally fit to play this high stress chess game that is fundraising. So peak performance in the mind and the body will result in a good fundraising process.
I love that advice so much. And I think that a lot of founders forget about those two very important aspects, the mental health and the physical health. So I think those are really good points that you raised there. Thank you.
I would only add to this picture that if you're in a fundraising process now, also conserve cash. And hang in there. This environment that we're in is not going to last forever. It's right that we're seeing that maybe by summer 2023 or maybe by fall 2023 is what we're reading, that we'll be out of it. So make sure that you are set up to be fine until then.
If you liked what you heard on today's podcast, please subscribe on Apple, Spotify, and please share this content with your peers on your social media channels and in other ways that it'll reach as many people as possible. Our goal is to help more founders achieve success more quickly, and the best way to do that is by sharing our collective knowledge. A rising tide lifts all boats, and the more the WTIA tech community can help and support one another, the better.